So when we look at this 50-year running average is maybe 7.7% for a 30-year fixed rate mortgage, and we see the artificial suppression of what happens when you go south of 4%, that asset prices go through the roof. How sustainable is it to bring the mortgage rate back to less than 4% to not allow asset prices to decline? Is that possible? Because we know there's no reverse gear in the U.S. economy. And if asset prices drop below mortgage balances, that creates another crisis.
Interest rates usually follow inflation. So you have a change in the money supply, then you have a change in inflation, and then you have a change in the interest rate and mortgage rates. That's normally how it works. Now what you're suggesting is that, well, somehow we want to go against all of that and drive interest rates down to 4%. Now, the only way you can do that is to literally manipulate the thing in some way. And if you do, you're really asking for trouble.
That's what I'm getting at. The housing prices have to drop. They have to come down. Professor Steve Hanke, welcome back to the show.
Great to be with you.
For those who don't know who you are, you're a professor of applied economics at Johns Hopkins University, a distinguished senior scholar at the Mises Institute. You served on President Reagan's Council of Economic Advisors. You have been honored with many awards, one honoring you as the third most influential economist in the world. You earned your Ph.D. in economics back in 1969 from the University of Colorado, and you've authored and co-authored many books and have written in numerous academic journals. Recently, you published two significant books, Capital, Interest, and Waiting, which you co-authored with Leland Yeager, and Making Money Work, you co-authored with economist Matt Sikerski. I hope I said that right. Professor Hanke,
You got it.
you are
You got it.
very distinguished, sir, and well known around the world. It's an honor to have you back on our show. I want to start by talking about inflation. Now, nationwide inflation appears to be showing up. I'm hearing that retailers like Walmart, for instance, have needed to raise prices on certain products because of tariffs. This coming after months of what appeared to be a muted effect. What are your thoughts on the tariffs, and will this cause inflation to the American people?
Well, the tariffs themselves will probably cause a little pop up in inflation, a little temporary pop up, and then inflation will continue to do what actually it's been doing for the last couple of years. It'll come down. And the reason for that is that inflation is always and everywhere a monetary phenomenon. And the money supply for the last 2.5, 3 years has been very anemic. Even now, its growth is only about 4.5% per annum. And Hanke's golden growth rate for the money supply, a rate consistent with hitting the Fed's inflation target at 2%, is a little over 6%. So the money supply has been growing very slowly for quite some time, and usually with a lag that works into a slowdown in inflation. So I've been anticipating that inflation would continue to slow down, but there might be a little temporary blip up because of these tariffs.
So explain again, how will this not continue to rise? I mean, if product prices, the cost of bringing products into the U.S. cost more money for the country exporting them.
Oh, well,
how does that not?
It'll just be a one-time pop. It'll pop up, but then it'll start going down again. In other words, it doesn't. It is something that is not cumulative. The tariff just happens once.
But on each product.
That's right. But again, you put all these things together, and it has a one-time pop. It's like, for example, and especially in developing countries, sometimes they'll have a currency crisis, and their currency will drop significantly in value, and they get kind of a one-time pop up in inflation as a result of that. That's the one-time pop kind of thing, and then inflation will start trending whatever way it's been trending, based on what's been happening to the money supply in the prior year or 2 years before you're looking at the data. So that would be one thing. Another thing, sometimes countries put on sales taxes or ad valorem taxes, and that will increase the price level once. It'll jump up. And that's the most similar to what's going on with the tariffs, because the tariffs are a sales tax on Americans. That's all that's happening. I mean, the thing Trump's smoke and mirrors coming out of Washington is that foreigners pay for the tariffs. No, Americans pay, because the person who imports the goods from foreign countries is the one who pays. It isn't the one who exports the goods that pay. It's Americans that paid. So what we're going to have, one of the biggest tax increases we've ever had in the United States because of the tariffs. And that increased sales tax on Americans will pop up the consumer price index once. It'll have like a one-time pop when the tax is imposed, and then the CPI, the consumer price index, will start trending in a way that's consistent with what's been happening to the money supply a couple years ago. And that what was happening a couple years ago is the money supply is anemic and shrinking. So that means that the trend, once the pop-up occurs, then the trend will set in again and inflation will start coming down.
So that's essentially disinflation. So we'll see this tariff as inflation, and then it will cool down based on year over year, because you're essentially only bringing that tax in one time when that product comes in. And is that what you're saying? Hey guys, I hope you're enjoying the show so far. I just wanted to take a brief minute and share some exciting news. I have just released my new Todd Simple home buying course. This course is designed for anyone wanting to know how to buy a home. It's designed to take you through the entire home buying process from start to finish. You'll learn how to represent yourself should you want to avoid paying real estate commissions, the best ways to shop for a home, how to avoid costly mistakes, what to look for when touring a home, negotiation tactics, and so much more. In this home buying course, I hold nothing back. In fact, I would go to say that no one has uncovered the home buying process like I have. I've even made a way for you to gift this course to your family and friends. Visit saxrealty.education. The link is also pinned in the comments below. Now back to the show.
I mean, for the people reading the newspaper and looking at the consumer price index, the tariff will be a sales tax on Americans, and that somebody in America pays for that. And as a result, the prices that they're paying go up because there's a tax on whatever they're importing. You're buying a bottle of wine from France, and all of a sudden, boom, there's a sales tax on it, a special tax, and so the price of that wine will in fact go up, and that will come into the consumer price index, but only once.
Right.
And then
essentially that price stays the same though. And then when you buy it again, it's now at the higher price, which to me essentially works the same as disinflation, where you're just not seeing it, or maybe it just stays the same. But yeah, I get it. So what's happening right now when Trump is saying that he wants to send out money to, give everybody, a family of four, maybe $2,400 or $600 per person as a sort of like a bonus because of these tariffs. Essentially, this is just the money back that we're paying. So if you were consuming these higher priced items, then you're just getting some of the money back that you paid.
The money coming back to you is not going to affect the price.
Right.
So what we were talking about with the prices doesn't have anything to do with this refund or whatever this stupid thing is going to be.
Yeah.
By the way, that'll be a very costly thing to do. They'll have to administer that, and that'll be also another beautiful item subject to a lot of waste, fraud, and abuse. So he's making this whole thing very complicated. But the bottom line is what? The bottom line is you're going to get a tax increase because of this new sales tax, and you'll get part of it refunded. But the initial impact on you is going to be at the wine store when you buy the bottle of wine, and the refund is not going to have anything to do with that price.
Right. So are you for these tariffs, or it sounds like you're not for them?
Oh, I'm totally against. This is the stupidest thing. Now let's get into why it's so stupid. The premise behind it is rubbish, because what's the premise? Trump is telling us, he talks to us exactly like he's on reality TV. So there's no economic basis whatsoever for this, because the premise is what? The trade deficits we have with other countries are because those other countries are unfair. They're treating us unfairly. They're screwing us. And as a result, we have a trade deficit, and the trade deficit is bad. Well, both of those items, those premises are bad, because the trade deficits are created by Americans, because Americans spend more than the value of the gross national product. So if they add consumption, investment, and government spending, those three categories of spending are greater than the gross national product, and they've been greater since 1975. So the gap has to be filled by imports being greater than exports, running a trade deficit. It's just accounting arithmetic. It's called an identity in economics. So Americans, the trade deficit is made in America. It has nothing to do with the foreigners. Now, the question, is it good or bad? Well, it's good, because Americans have been able to consume more than they produce and finance it very cheaply, and import capital to finance it very cheaply, because the dollar is the international currency. Everyone wants a lot of assets that are denominated in U.S. dollars. So we have no problem financing it. So one premise that Trump has is that trade deficits are caused by foreigners being unfair. False. The trade deficit's caused by Americans spending more than the GDP. It's just simple arithmetic. The second thing is that somehow he thinks these are bad. Well, trade deficits, as long as you can finance them easily, they're good, because you're allowed to actually consume a lot more than you produce. So that premise is wrong. Now, I think we'll find out also, Todd, that the legal premise and basis for these tariffs, these broad tariffs that are going in, is going to be illegal, because Trump's used an old law, and that the state, it's an emergency. We're in an emergency, and that law, he's invoking this emergency act to justify the fact that he's putting these tariffs on everyone. He claims that the trade deficits are a national emergency. Again, just complete rubbish. And it's right now in the Court of Appeals, and I think there's a good chance the Court of Appeals is going to conclude that this is illegal. And if it does, I doubt if the Supreme Court will take it up even. I think that will be the end.
Hmm.
And he's going to have huge egg on his face because he's going to have to back off all of this stuff and then use another rationale for putting tariffs on specific things.
Well, I know the
Which
tariff.
he, by the way, he can do. He can put tariffs on, steel and copper and various specific things for national security reasons. But this broad-based emergency act that he's using to put these broad tariffs on Canada, Mexico, the European Union, everybody. I think that's illegal. Number one, this is not a national emergency, and I think that's the way the court will see it too. But we'll find out in the next week or two.
Yeah. Well, I know it's been on again, off again, on again, off again. The rates have been changing. What about what Trump refers to as, because of the tariffs, it encourages these manufacturers to bring their manufacturing stateside?
It's not going to happen. It's a pipe dream. It's another, you know, he's peddling something that's just not. These aren't deals. The European Union, the big deal. They were going to invest over $600 billion in the United States. That's not a deal. It's not in writing. No one signed it. And the European Commission can't force European companies to invest in the United States. It would be illegal. So it's all BS. None of this stuff is in writing right now, by the way. All these deals that Trump is talking about and trumpeting are not in writing, and they're not signed by anyone. And most of these promises are just pie in the sky thing, kissing up to Trump, making him look good for a TV announcement, but they can't deliver.
Well, I know, just hearing him say that the economy's strong and everything's doing well, and we see the exact opposite, at least in my little world, where we're dealing with home buyers wanting to buy a home or homeowners trying to stay in their home. We're hearing a lot of activity where people are concerned that their prices have gone up, the repair cost, the maintenance cost, the taxes, the insurance, and I don't really see where, talking to a lot of employers locally. I mean, we're in the same state, not that far away from each other, and speaking with a lot of the small businesses that owners that I know, they're not feeling things are doing well at all. In fact, they're not thinking about pay raises, and they're thinking about, how do I cut back and eliminate labor costs?
For some time, due to the fact that we've had this anemic growth in the money supply, we know when that happens that it will cause the economy to slow down. So I've been predicting a slowdown. And although the second quarter GDP number came in at 3%, and Trump was saying, "Oh, we're in a Trump boom, everything's going well," he forgot to tell us that there was essentially no growth in the first quarter of the year. So if you look at the first half of the year, it's growing a lot more slowly than it was in 2024. Exactly what I've been predicting. We're slowing down, and I think there's a very good chance we're going to end up having a recession as a result of this slowdown, and that slowdown caused by anemic money supply growth. Then you add the Trump into the picture, and Trump creates what's called regime uncertainty. He's changing everything all at once. And once you start changing everything all at once, you get business people like you. You say, "Hey, I'm going to wait and see where the dust settles on this thing before I do anything." And the last time we had this kind of situation was with Franklin Delano Roosevelt and the New Deal in the 1930s. And the New Dealers were like Trump. They were changing everything. they even engaged in outright theft because they revoked the gold clauses in contracts in the United States. So, and it became illegal to hold gold in the United States. So they were changing everything. You had a lot of regime uncertainty, and what was the result? The result was from 1929 to the start of World War II, there was no investment in the U.S. It was zero. And what happened? The Great Depression was a lot deeper and lasted a lot longer than it would have if we hadn't had the wonderful New Dealers. You read about this in history books, and New Dealers, how great they were. They saved Americans. No, it was just the opposite. They were a complete disaster. They created huge regime uncertainty and made things a lot worse than would have been the case if they hadn't been around.
When you talk about, and I remember the announcement where they said that I think it was 3% GDP growth. It was just a modest increase. How much of that do you believe was because of companies buying products ahead of the tariffs?
Well, ahead of the tariffs, that's actually one reason the first quarter was zero. So that did come into play, but that came in the first quarter data.
Steve, so I get that with first quarter. I guess what I'm asking about this second quarter information or the bump up in GDP, I mean, isn't Trump still talking about the EU and potential tariffs? And then also, isn't there consideration of adjusting the tariffs higher for some countries?
Oh yes, but that's why I say these are not deals. There's nothing in writing. There's nothing signed. It's all very unprofessional. And even if you know what Trump has in his mind in terms of a deal today, he might change it tomorrow.
So, but would that increase the GDP? I mean, businesses obviously have to know this and their uncertainty.
No, it starts shutting everything down. It's part of this regime uncertainty. It's another aspect to the regime uncertainty, and that's the fact that Trump is a very mercurial personality, and and so you don't really know what he's thinking. And even if you did know what he was thinking today with certainty, you wouldn't have any idea what he's going to do tomorrow because everything is under a shroud of secrecy. It's you don't know what the guy's going to do. So this is bad for businesses because you're a businessman, and if you don't know what the leader of the country or the governor of the state or the state legislature or the Congress, if you don't know what they're going to do that might affect you and your business and your investments, what do? You hunker down.
Absolutely. All right, Professor, let's talk about the Federal Reserve. Seems like a lot of pressure on Powell to drop interest rates. Do you believe that the Fed should drop rates?
Well, I don't think the people should be focusing on interest rates. Number one, that are controlled by the Fed, meaning the overnight interest rate is the Fed funds rate. And that's something the Fed controls, and that is the wrong thing to be looking at. Both Trump and Chairman Powell have the thing completely wrong. Most of the financial markets do, of course, the financial press. Monetary policy and the stance of monetary policy is not given by interest rates, the Fed funds rate. It's given by changes in the money supply. So the question is, what are you going to do with the money supply? Where is the money supply? And the money supply, as I said, is growing at a very slow rate, 4.5%. Credit creation by banks also is growing at only 4.5%. And we have to get the money supply growing a little more rapidly. Now, how do you do that? Well, it isn't the Fed funds rate. You stop quantitative tightening. The Fed now is engaged in a tightening policy, what they call it quantitative tightening, shrinking the balance sheet of the Fed. That's one thing. The other thing, and this is something that Matt Sikirky and I get into in great detail, is bank regulations, because banks create most of the money supply, and about 80% actually. 80% of broad money in the United States, it's not produced by the Fed. It's produced by commercial banks when they extend credit to you or me or whoever is receiving the credit. So the bank regulations right now, there's one reserve requirement that came in at the time of the great financial crisis, and it's called a supplemental liquidity reserve, and that does constrain banks. It hampers it reduces their capacity to make loans, basically. And fortunately, the Fed actually is talking about taking that off, that supplemental liquidity reserve requirement. So those are the two ways that you could loosen up. There are other ways you could loosen up too, but the Fed funds interest rate, this obsession with the interest rate, is just the wrong way to go.
What is the reserve requirement? I mean, what that you're talking about?
The reserve requirement it's very cumbersome and constraining for banks, because they have to hold the same amount of reserves on assets that are U.S. Treasury bonds and bills, for example, than they do for other kinds of, commercial loans, mortgages, things like that. So it requires them to hold really way too much in terms of reserves.
So you're not talking about the bank vault reserves that is no longer required for them to, I think it was, they had to have 10% of their deposit money in bank vault.
No, this is to cover all the assets that they have. There's an add-on, and the add-on is a supplemental liquidity reserve, and that means they have to tie up bank capital for that legal mandate, and that constrains them. They don't have as much firepower. Let's put it that way.
Well, if you're a business and you need a commercial loan to buy inventory or to expand, and you're hearing that the president wants to drop 300 basis points and significantly lowering the cost to borrow money. I mean, if the bank can borrow the money from the government, why would a company go out and take on this debt now? But if they do drop the interest rates, wouldn't that do what you're saying? Wouldn't that encourage the banks? And I'm not saying that I'm for interest rate cuts. I'm not at all. But I think that if a bank can borrow money cheaper in that overnight trading rate, and they can extend lending at a cheaper cost, then you would think that commercial businesses or certain consumer loans, it would stimulate people to go out and take on more debt. Is that the wrong way to think about that?
Well, that's not the way it works. The way it works, number one, the banks aren't engaged in borrowing much with the overnight Fed funds rate.
Okay.
So that's a very short term thing. So that's one problem. But the big problem is if you lowered the federal funds rate by 3 percentage points, which Trump is arguing they should do, what that would do, it would increase the long-term interest rates that are determined in the marketplace, like the 10-year bond and mortgages the rates would go up. So you'd be facing a stronger headwind. If I guarantee you, if they reduce the Fed funds rate by 3 percentage points right now, mortgage rates would go up, not down.
So when he's saying
And
that,
long-term lending rates would go up. The yield curve would get a lot steeper. And the reason for that would be that inflation expectations would get unanchored. People would say, "Oh God, they're going to flood the place with money, and inflation's going to come back," and things like that. So the mechanics of what you went through, it doesn't work that way, because the the interest rate that people face in the real world, it isn't the Fed funds rate. It's the rates for loans of the duration that they're taking out in the marketplace. And I can guarantee you, his suggestion, if followed, at lowering the Fed funds rate by 3 percentage points, would increase the interest rate on 10-year bonds and increase mortgage rates. It would completely backfire. What he's talking about is nonsense, basically. And to prove this, he makes a calculation. Trump does. He said that if they lowered the Fed funds rate by 3 percentage points, it would save billions of dollars for the federal government in terms of interest cost on loans that they have to, credit that they have to receive to finance a fiscal deficit. But the problem is that the government doesn't borrow at the Fed funds rate. That's an overnight rate. They even Treasury bills are much longer dated than the Fed funds rate. The average duration of the debt in the United States is 6.5 years, a little over 6 years. So they're borrowing on average at that rate, not the overnight rate. So it's all smoke and mirrors what Trump is talking about. He doesn't even have his arithmetic right.
So when he says that the Powell needs to drop rates by the 3%, 300 basis points, when he says that, because Americans can't afford to buy homes, you're saying that's complete nonsense. That has nothing to do with it. In fact, dropping the rate would more than likely increase mortgage rates.
Correct.
Wow. So let's talk about housing for a minute. It's frozen. We're seeing home prices are starting to come down. Housing is unaffordable. In your opinion, you've been around forever watching the economy, the U.S. economy, being a part of that. What is more important, that price of the house or the interest rate for the mortgage if they're financing? What if you, as a borrower, what is more important, getting the house at a better price or a better rate?
Well, that's a complicated question, actually. As a real estate guy, you know it. They all work together. So it's if the price is lower, it's a good deal for the buyer, and if the interest rate on the mortgage is lower, it's a good deal for the buyer. And so you got both of these things working on you.
But when you take
look at it this way, Todd. It's what your work out the effect of the price and the mortgage, and the bottom line is what your down payment is going to have to be. That's the upfront cost, and what your monthly mortgage is going to be. Those are the bottom line is how these two things affect, one, the down payment, and two, the monthly.
Right. And that's if you're planning on keeping the home. But if you're moving and you're buying at the top of the market, we've manipulated these interest rates through the years, and we've never seen, quantitative easing, the Fed buying mortgage-backed securities, suppressing mortgage rates to 2.7 some percent over the last 5 years, really created this asset bubble of home prices to skyrocket. Now the mortgage rates are 7%. The home prices are priced at 2 and 3 handles, let's just say. So what do we need? Do we need cheaper mortgage rates, or do we need a home price correction, I guess is a better way of putting it?
Well, if you're a buyer, you need both.
Yeah, I mean, Trump knows you buy low and sell high. You don't buy high and sell low like the risk
Right.
to do right now.
So, so the whole housing thing, it, 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 it the price aspect does, I would put it this way. The price aspect is very much affected by local conditions, local regulations, building codes, property taxes, zoning is big time. All that's very local. The, the national thing is the interest rate on the mortgage. So you've got kind of a split here. I think the biggest factor affecting the home price is very localized.
What about the fact that even, I mean, if you look at locally, it all seems to be um, out of whack from median household income to median home price. It's still, I mean, since 1971, it seems like it's gone off the chart as far as every year the affordability index is getting worse. I mean, that's pretty much even a market specific thing. I can just take Maryland, for instance, where we have the average household income is $90,000. I mean, you're at 5 and 6 and more times median household income for a home. I mean,
well, one reason for that, there is a national thing that does affect the price too, and that is there the system is designed in such a way that in from kind of an optimal point of view, if you work out the thing, too much money is going into housing and real estate. That's the name of the game. Ultimately, that is a national macro thing. By the way, we've got Fannie and Freddie in there. We've got in effect a huge tilting of everything towards savings and liquidities going into the real estate. It's not a neutral situation. Real estate is highly favored, and that creates this kind of artificial, shall we say, pump up in price. And you could see it most vividly, by the way, prior to the crash in 2007. That's when it kind of reached an apex, kind of a fueling the thing. And you talk about bubbles. There were a lot of bubbles then. So, and we had the same kind of thing happening. Remember, you remember very well the savings and loan crisis.
I do.
In the 1980s. That was another thing where the speculative, it's a speculative aspect, the kind of irrational exuberance, but it's all government policy funneling funds and savings into real estate. And what happens, by the way, and this happens all over the world. It's just not the United States. What happens is that you have a housing cycle, a real estate cycle. Typically, it lasts about 16 years. It goes up, and at 16 years, the bubble pops and it goes down, and then it starts going up.
What would happen if mortgage rates went back down? What would happen to the asset prices? Are we in?
This is how the mortgages do work into these things are all interrelated, and to work out the effects, you really have to get a sharp pencil out and figure the thing out. But if their interest rates go down, if the mortgage rates go down, that that does what? It enhances the demand for whatever you're taking out the mortgage on, and the price goes up relative to what it would have been if the mortgage rate would have been higher. I mean, it's a simple game. I mean, in a way, your business, it's just a classic thing that you can teach students. The effect of interest rates on asset prices and things like that. And if you even if you take a handheld calculator and they're all programmed to figure out these mortgage effects,
So,
the interest rate effects on a mortgage. And
so when we look at this 50-year running average is 7% for maybe 7.7% for a mortgage rate, 30-year fixed rate mortgage. When we look at that and we see the artificial suppression of what happens when you go south of 4%, that asset prices go through the roof. How sustainable is it to bring the mortgage rate back to less than 4% to not allow asset prices to decline? Is that possible? Because we know there's no reverse gear in the U.S. economy. And if asset prices drop below mortgage balances, that creates another crisis. So what do you see playing out here?
well, no, no, the normal course of things is that there's the following three-step process. One, you have changes in the money supply, and those eventually work their way through to inflation. And for example, I've looked throughout the world, and when we've had data all around the world, there's never been a significant inflation that hasn't been preceded by a significant increase in the money supply. So you increase the money, and when I say significant inflation, I mean one I define as a significant would be 4% per year lasting for at least 2 years. That would be significant. So if I use those measures and look all around the world, sure enough, every time the inflation goes over 4% and lasts for more than 2 years, there's been a significant increase in the money supply a year or two prior to that inflation breakup. So that's the first two steps. Now the third step is that interest rates usually follow inflation. So you have a change in the money supply, then you have a change in inflation, and then you have a change in the interest rate and mortgage rates. That's normally how it works. Now what you're suggesting is that, well, somehow we want to go against all of that and drive interest rates down to 4%. Now, now,
Well,
now, the only way you can do that is to literally to manipulate the thing in some way, and if you do, uh, which might be possible, you're really asking for trouble.
that's what I'm getting at. Believe me, I don't want to see it happen, but what I'm seeing is that if interest rates stay persistent or consistent to the 50-year running average, the housing prices have to drop. They have to come down because people can't afford the asset price that was set by a sub 4 or sub 3% mortgage rate. That's where they're set. So my point is that is the Fed stuck, or is this, or maybe it's not the Fed, is the system stuck to where having a housing correction or price crash is the only true solution, which gets back to the question, is it the asset price of the house, is that better than the interest rate itself? Because I think you agree with me, 4% or less mortgages again would be lunacy.
Well, yeah, well, get that that's probably correct. Given the unless you had much lower inflation, if you had no inflation, it depends on what the inflation rate is. But if inflation is normal, you're let's here's what you're describing and you're grappling with, and you're describing it very clearly because that it's your business. You know what you're doing. So, or I assume you know what you're doing because you've been in business, a real estate business, for a long time. If you didn't know what you were doing, you would have gone to the wall a long time ago. And at any rate, getting back to the point that you're making, it's the following. It's like, the guy who goes over the Niagara Falls in a barrel, and down at the bottom, of course, there are a lot of reporters. A guy comes staggering out of the river, and they put the microphones in front of him, and they say, "Well, how was it?" He said, "Well, it was pretty calm above the falls, and it was pretty calm below the falls, but the transition was a bitch." That and you're talking about the transition.
I guess I am, yeah, and I think a lot of people are concerned about the transition, but yet you have the news reporting that the National Association of Realtors said that the median home price has gone up even higher despite the lack of sales. And what they're not explaining is that has nothing to do with the home price going up or down. That just tells you who's buying houses. Because if you're comparing that year over year, obviously, if people with money are buying more expensive houses, that number will reflect that. And I think that
So yeah, but by the way, the mortgage interest rate and the house price thing are all very interrelated and so forth. And part of the thing, and the easiest way to describe another transition problem is the transition and moving from house A to house B. When you bought house A at a very low interest on a mortgage, and now you want to move to house B, but you're going to have sticker shock when you see what the interest rate is. So what do? You don't
stay
move. You don't move. You stay stuck.
right.
And so there are just so many problems with this that are tangled up with the fact that they had these artificially low interest rates for quite some time, artificially low mortgages, and we don't have them anymore. By the way, what you said that the long term average on the 30 years was around 7.5%, or you said 7.7. What is it now?
It's about six. Well, I think it fell maybe 0.12% in the last couple of days. If you have 20% down and very good credit, you could probably get somewhere in the 6.7% for a 30-year mortgage. Maybe there are, there's certainly builders that are offering rate buy downs and sellers that are doing it as well. But I think right now it's right around 6.6 or 6.7%.
So from what you described, that would be the best credit. Okay.
Correct.
So my guess is the average is probably pretty close to the long-term average of 7.7.
Probably.
Because the number you gave me, 6.7, is lowballing it.
Right.
I mean, you're from what you said, you're going to be pretty lucky to get 6.7.
You have to have a lot of things going in your favor, yes.
So my guesstimate, my back of the envelope guesstimate would be that we must be, on average, if you take everybody in there, it must be pretty close to, if the long-term average is what you say, 7.7, I bet that's pretty much what the average is now.
Could be.
Anyway, so in that sense, what we're saying in this discussion is that things are kind of in a long run equilibrium as far as the mortgage goes.
Right.
But the problem is the thing we were talking about before, and that is, what about everybody who bought with a 4.5% mortgage
Or less.
or less?
Right. And
They're stuck. I mean, they're going to have to move. They're going to have to pay a high premium.
Yeah, and some don't have a choice.
And that's one reason the real estate market's plugged up.
Let's go the flip side of things. Let's say, okay, The way to do this is to grow us out of this mess, growth, have businesses doing well, encouraging them to pay their employees more money. What's the possibility of that with the fact that AI is looming here in the near distant future, robotics, and with employees being a very high percentage on most companies' income statements, they're always looking at ways of shaving that down, not increasing it. If their business runs a 26 or 28% salary expectation, just using that for an example, they're not saying, "Oh, this is great. I want to bump that up to 36% or 40%." It goes against the business wanting to run leaner and meaner and more profitable. What do you think is going to happen with our income outlooks? Do you think that we will see not just running along with inflation, because that has not averaged a 3% increase annually or 4% increase annually on salaries? That's not enough to keep up with the true cost of living. That's just keeping up with whatever CPI inflation numbers they want to tell us what's happening. What's the chances that we see where people are going to get significant raises from America's businesses?
Well, the idea of growing out of all these problems, I think, is a little bit and the AI hype. There's a lot of hype in indicating or suggesting that we're going to somehow grow a lot faster, and that will eliminate all these debt problems and or at least mitigate the problems associated with too much debt. So my take on that is that the growth potential in the United States is running a little over 2%. That's the long run kind of sustainable growth rate. And even the more optimistic, realistic assumptions about AI is that the AI might increase that a little bit, not very much. Maybe we go from 2.2 to 2.3 or 2.35. So that nothing really changes that much. It's not this revolutionary thing that's being hyped in the press. Even if you work the numbers out on the most optimistic scenarios, it moves the needle a little bit, but not very much. So we're basically in the soup that we've been discussing earlier, no matter what. So, in short, don't hold your breath that we're going to be rescued by AI.
Do you think we'll see wage growth, or do you think we'll see that stagnate?
Over the long term, wage growth usually shadows changes in labor productivity. So it depends on what happens with labor productivity. If labor productivity continues to go up like it is, wages will go up like they've been going up. And there are cyclical things that happen. For example, during COVID, what happened? During COVID, the average real wage didn't go up as fast as inflation. So people were on wages were really getting squeezed big time. The people who made out during COVID and the increase in the money supply, increase in inflation, that increased asset prices. So people who owned assets, rich people, made out very well. And one stunning number is the fact that billionaires' wealth as a percent of GDP in January of 2020, right before COVID, the month before COVID, it was 14.1% of GDP. Now it's 21.7% of GDP. Billionaires' wealth as a percent of GDP went from 14.1 before COVID to 21.7 now. So the billionaires were made out like bandits with this huge inflation, because the inflation happened where? Housing, real estate. Real estate went up, land prices went up, the stock market went up. And who owns all this stuff? Well, rich people do. The middle class, and certainly the lower class, they have balance sheets that are in deficit. They owe more debt than the assets that they own.
Steve, you had said that you thought that productivity is up, is increased. Where do you get that, I guess, from? I'm not trying to be disrespectful, but I see productivity has gone down.
Well, no, it depends. I think productivity in my office has gone down too, but that's another story. But in general, if we aggregate and look at the overall economy, productivity marches up. It goes up, and salaries go up, shadowing the increases in productivity. And the other thing that we threw into the pot, we started talking about AI, and AI looks like it will increase productivity relative to what it would have been without AI. It'll add a little something, a little more wind in the sails of productivity, but nothing like we're getting from the hype from Silicon Valley. That it's going to change the world, and productivity is going to go to the moon, and it's not going to happen, because AI, where is it focused? Where does it help? And where do robotics and things like that help? Well, they help at very routine, repetitious jobs, and those jobs aren't all the jobs. They're a very small part of the jobs.
Professor Hanke, you are obviously at Johns Hopkins. You're seeing or must have some kind of idea of forecast for universities throughout the United States over the next 5 years, 10 years. With everything that is changing in AI, and given the fact that we have a very high unemployment rate of graduates now graduating college, whether they're 4-year degrees or their master programs or doctorates, whatever it is. I mean, it seems like a lot of students are having a hard time finding jobs, especially in the careers of their studies. What advice do you give our youth nowadays that tells them about formal education, and what type of career path do you forecast that you would tell these young kids that are considering going to college for 4 or 6 years?
Well, a couple of things. One, I've been a professor for about 60 years, so I've been around. I've been to this rodeo many times and watched what's going on. I think the level of training, useful training at universities, has gone way down, and that, of course, even includes elite universities like Johns Hopkins. I mean, it's gone down, and let me just tell you what I do compared to what the average is going on. So I run what they call Hanke's atelier, Hanke's workshop. So I'm teaching the students how to actually do things in finance and economics, and they all get placed on Wall Street at their top jobs, 100%. You can read about this. There are articles written about it in Bloomberg's and Barron's and things. My students, if they get a recommendation from me, they land their top job. So they have zero trouble. They're all placed extremely well. But that's because I teach them how to actually do things. It's just not the usual BS you get in most of these courses. So So it's training. The training level has gone way down, and the skill sets that the students have, they've gone down over time. And things I emphasize, even things like writing skills. I require a lot of writing because most of the students, believe it or not, are more or less illiterate. I mean, most students, the young ones, the Generation Z, they haven't even read a book. They don't know where the library is. I I had a student the other day, and I wanted to one of my assistants, and I wanted him to go over to the library and check out a book. Well, he didn't know how to do that. He didn't even know where the library was because he'd never been there. I mean, this is astounding.
Wow.
Even for me, it's shocking. And my students, by the way, to get into my courses, have to have about a minimum of about a 3.7 GPA. They basically have to be straight A students to get in the first place. So I see this, and I train them and get them up to speed. And the reason I know it works, there are two reasons. One is that they're all placed at their top pick across the board, 100%. Two, the employers that are employing them get back to me and they say, "Oh God, thank you. Give me some more people like that. Give me some more people like that." Because after a week or 10 days of training, they're in the groove and producing something with a positive value at whatever bank or brokerage or wherever they happen to be on Wall Street. And and usually what happens, most people going from most universities, not trained by me, what happens? They go and it takes them a year or something to be trained so they can do something. And that's very expensive. If you hire somebody at Sachs Realty and you've got to waste a year's time investing, mentoring them, teaching them how to tie their shoes, teaching them how to I teach them how to be professionals. I teach them how to write.
Yeah, well, what you're saying is very true.
Things and what it does for the employers love it because it essentially eliminates training time. And training time is a huge investment for a new employee.
And what a lot of employees don't realize is that if they're uh, not going to stay at that company, that's a big concern. So employers have to look at the resumes and say, is this employee going to be here? Is this job really going to fulfill this employee's desires enough that if I train them for 7 months or a year, are they going to just leave me when another opportunity comes along? That's very true.
Oh, this is happening on Wall Street. Let me give you an example. J.P. Morgan. Now, if originally would go in to J.P. Morgan in investment banking, and then they start looking around for an investment bank to go into private equity and that kind of thing. So they're looking around, thinking about jumping ship. And finally, Jamie Dimon, chairman of J.P. Morgan, says, "No, you're signing an agreement with us that if you're prohibited from signing another agreement with an investment bank and jumping ship right away
Mhm.
because they have to invest so much into these young people that are starting to teach them the basics that they don't want to lose that investment. They invest a huge amount of time, and whoever it is, the guy or the gal, they leave in a year to go in a private equity operation, and J.P. Morgan has basically trained them so that they have a skill set they can use at the private equity operation. And finally, Jamie put his foot down. He says, "No, this is going to stop."
Hmm.
But now with my people, that's not a problem because Jamie Dimon, my best student this year, where did he go? J.P. Morgan. He just started about 2 weeks ago in New York. Top guy, top job, and bingo, he's producing right away. he needs no training.
Yeah. Well, Professor Hanke, we always appreciate your wisdom, and you certainly, I'm sure you've opened some eyes and set some records straight here today. And we look forward to having you back again. And as this whole U.S. economy unfolds,
There'll be plenty to talk about, Todd. This this the game is going to get more dynamic, I think, and get more dynamic, by the way, as the economy slows down.
well,
We have a situation where the president is flailing because he's failing. Stay tuned.
yeah. And all of your links are in the show notes, and I highly encourage people to check out your work and your books, and we'll talk to you soon.
See you, Todd. Thanks.
Uh-huh. Thanks so much for watching. If you liked the video, you can let us know by smashing that thumbs up. And if you haven't already subscribed to our channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. Keep those comments and questions coming. And one of the biggest compliments you can do for us all here at Sachs Realty is to share our channel and this video with your family and friends. This will help us to continue to build this amazing online community with viewers just like yourself. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.